All right, in this lesson, we are going to put to practice our journal entry skills as well as our debits and credits by doing examples. Now, there are 14 examples that we're going to go over. I've split it up into 2 lessons just because it's going to get a little long as we talk about the first 8 in this lesson and 6 in the next lesson. So I thought I would break it up just a little bit. But what we're going to do is we're actually going to follow some of the steps that we actually learned in the last lesson, where we're actually going to look at the accounts, the components, the amounts, the increases and decreases, and then applying the debits and credits to the economic event that we are going to be dealing with in each one of these examples. So that's what we're going to do in this lesson to hopefully give you a better understanding and practice on how we prepare journal entries from debits and credits and the economic events that impacts a company's financial statement. So let's get started with looking at the first example here. Now the layout here, we've got a couple of things working for us. I want to walk you through what we have here. So if you notice here, we've got, our example information. Below this, I've got our steps basically in these blocks. And at the very bottom, I've got our journal entry blocks that we're going to fill in. Right below me, you have the key that we learned in the prior lesson where we're talking about debits and credits and how they impact different components. So let's get started here with this first example. It says Scott incorporates Company A on August 1st, 20x1. The company issues common stock to Scott as evidence of his contribution of $10,000 cash, which is deposited into the company's bank account. Now, as we are looking at these examples, we are Company A. Everybody else is external from us. So in this case here, the question that I would ask ourselves is, does this meet the definition of an economic event? And this does, because there's something being exchanged. So if something's being exchanged, the next question that I would ask is, what is being exchanged? Well, I am getting cash because I'm Company A, and I'm giving up, or another better word for this is I'm issuing stock to the shareholder, so that Scott here owns a part of Company A or all of Company A in this situation. So in this case, Company A is getting cash and giving up common stock, or giving common stock to Scott. So the next question here is the accounts. Well, again, we're thinking logically, what was exchanged? What was exchanged was cash. So we're going to put cash here as an account. And then common stock, right? I'm issuing common stock or stock to Scott. So common stock is going to go here. All right, the next step after that is we have these accounts that we're going to be using. Now we have to tag them to one of the 6 components that we learned in this series. So in this case here, we know that cash is something that provides a company with future financial benefits, and therefore that's going to be classified as an asset. And then we've got our common stock. Our common stock is a reference to an equity or owner's equity. So owner's equity would go here. All right, so now that we have an account, we've classified them to their components. The next question here is the dollar value. How much was exchanged in this transaction? Well, in this case, $10,000 was exchanged in this transaction, and it happens to be both ways. I got $10,000, Scott got $10,000 worth of common stock. Then the question here is, did something increase or decrease? This is where it gets a little bit confusing, especially on the owner's equity. But on the cash side of the house here, I'm Company A. I receive cash. If I receive cash, that means my cash increases. So I'm going to put increase here. Now, the mistake that most people make here is that they assume, okay, if the first one is increased, the other one has to be decreased. That's not the case. We look at each one individually rather than collectively for the whole economic event. So in this case, common stock. Now, this one's a weird one, and this has always been a weird one, but I'm not giving up stock, really. I'm issuing stock, okay? Frankly, Scott has more ownership in our company because we have his $10,000. So this one's a weird one, but common stock actually increases because I'm issuing more stock to Scott. So increases would go here. Kind of weird because I know some would say, well, decrease, we're getting rid of it. Well, we're not getting rid of it. We're issuing shares to Scott, who owns them, owns an ownership share in our company. All right. All right. So now that we have that, this is the basis here to then figure out the debits and credits. So what do we need to know? Well, we need to know what component and did it increase or decrease? So in this first one, cash, it's an asset. Assets over here. And it looks like it increased. So increases would be debits to the associated account. So we are going to debit cash. So I'm going to put debit here. What about common stock? So common stock is an owner's equity. Owner's equity is over here. That owner's equity, the dollar, it increases because we said it was increasing. So increasing would be a credit for common stock. So now it's time to do the journal entry. The first rule that we have is that debits go first. So in this case, our debit here is cash. So I'm going to debit cash by going all the way to the far left of our blocks here. And then the debit column is the second one. The credit column would be the third one. So my debit would be $10,000. I put nothing in the credit. We can only debit or credit per account. So in this case, I am done with cash. Then we've got the credit. So the credit here goes to common stock. So credit common stock. Notice here I've indented common stock. So there is this gap here from the start to when I start common stock, and I have a credit here of common stock for $10,000. Because it's a credit, it doesn't go on the debit column. Instead, we're going to put it on the credit column. And that right there completes this journal entry for example 1. So in this case here, we're going to debit cash for $10,000, credit common stock for $10,000. Now, before we move on, just a couple of things. Notice here that I've done the steps here. And the reason why I've done the step is not to make this a long process of doing journal entries, but it's to make sure that I understand how we get to cash being debited and common stock being credited. So if I can understand this right here, sorry, I didn't write credit here. If I can understand this process, as I do more of this, it becomes faster and faster and faster, and then it just rolls off your tongue on what you're going to do for that account. So debit cash, credit common stock. So hopefully you're good there. Let's move on to example 2. For example 2 here, it says Company A pays $300 cash to create a company logo. So what happens here? We, the company, give up $300 of cash to this company, and in return, they're going to give us a logo. So the question is, so we've got the exchange, so what accounts are affected? Well, we know cash is affected, right? So debit, or not debit, but cash would be one of the accounts. And then the question is we're going to give up cash. In return, we're going to get this logo. So what is that? Well, we could use logo. We could use, some would say, well, isn't it like marketing expenses? Could be that. In this case, I would say it's going to be trademark, okay? It's the reason why it's going to be a trademark is because there's value in that logo. So in this case, I'm going to do trademark. If you ask an accountant, you might get a few different answers, but we're going to use trademark because that's kind of the standard account that I would use for this type of item. So trademark here. And remember, as we do these entries and examples, it's okay if you don't know which accounts. The more you do it, the better you get at it. So, you know, at this stage of understanding journal entries and debits and credits, it's okay to be a little confused. Remember in your notes, I've given you 3 pages in those notes where you can actually see all of the common accounts that you would incur as maybe a first-year student would in an accounting course. All right, so we have cash and trademark. So the next question is what component? Well, cash is easy because we've talked about cash before in example 1. Cash here would be a asset or an asset. So asset there. And then what about trademark? Well, trademark is probably new to a lot of people, but trademark is an asset. It's something the company owns or controls that creates value. How do we know? Well, this shirt right here has an Under Armour logo. This logo is worth a lot of money. It provides future benefits for the company Under Armour. How do we know that? Because this polo probably cost about $5 to make, and yet if you want to purchase this polo, it's like 50 bucks, okay? So that $45 increase in price isn't because it has better product in it, it's because the logo gives it value, some type of economic value. So this trademark is going to be an asset to this company. All right, now to the dollar value. Well, the only thing that we know is that the exchange was $300, so that's going to be the value that we're going to assign here. Now, cash, is it increase or decrease? Well, company A pays $300 to the vendor, so if it pays $300 to the vendor, that means cash comes out, so that's going to be a decrease. And then what about the trademark? Well, the trademark, I have this asset, it's increasing that asset account, so I'm going to put increasing. And now I can go back to the key right below me and try to figure out what I'm going to do. So cash is an asset, the asset decreases. So asset decreases, it's going to be a credit. So credit there. What about trademark? Trademark is an asset as well. So it's an asset as well, but it's not decreasing, it is increasing. So increasing there, that's going to be a debit. Okay. Now notice here, I'm going to tackle the same component. Both of them are assets. All I'm really doing at this point is I'm exchanging one asset for another asset. That's all I'm doing. So in this case here, I've got a debit and I've got a credit. So first things first is the debit. So I'm going to debit trademark. Whoops. Went too fast, too soon. Trademark. In the amount of $300. And then I'm going to credit cash, giving that space here of $300. So that's what my journal entry looks like. So hopefully you're getting the hang here of once we figure out all the components that we need to, then all we need to do is go to our key and then just follow the key. All right, so that's our example 2. Let's head over to example 3. So in example 3, company A borrows $20,000 from a bank, depositing those funds in its bank account and signing a formal agreement to repay the loans in 2 years on August 3rd, 20x3. So what do we do here? Well, what's being exchanged? I'm getting $20,000 cash, and what am I giving up? I'm giving up the future cash flows that I'm going to receive sometime in the future, right? Because in the future, I'm actually going to have to pay the bank back $20,000. So what accounts do we use for that exchange here? Well, first of all, I'm getting cash. So that's going to be one of them. And then I'm giving up future cash flows. So that's a liability I owe. In this case, because we're signing a formal agreement, we call that a note. Why? Because when you sign a note, well, when you sign a note, it's a formal agreement. So we call that notes payable. Okay, so we've got cash and notes payable. Now we need to figure out what components these two things are in. So cash is an asset and notes payable is a liability. All right, so now that we have that, then what's that dollar amount? Our dollar amount here is $20,000. And the question is, did cash increase or decrease? In this case, it increased, so increase. What about our liabilities? Did our liabilities increase or decrease because of this economic event? Well, in this case here, we have got more liabilities, so the liabilities must have increased. So increase here. All right, so now we have to apply our debits and credits. So cash is an asset, that asset increases. So asset increases, that means cash, we're going to debit. With notes payable, it's a liability. That liability is also increasing. That means it's a credit. Now we just need to do the journal entry. So I'm going to debit here cash in the amount of $20,000. And I'm going to credit notes payable in the amount of $20,000. And that's going to complete my journal entry for this note. So again, we try to figure out what accounts and then what components and then increase and decreases, and then kind of look at our what I would say key here below me and just apply the key to our situation here. So debit cash, $20,000, credit notes payable, $20,000. All right, moving to example 4 here. Company A purchases and receives $9,600 in computer, printers, and desks in exchange for a promise to pay $9,600 at the end of the month. So what's happening here? I'm going to give this promise to pay, like an IOU, and I'm getting $9,600 of this computer, printer, and desks. So what's being exchanged? I'm getting equipment. I'm giving up a future cash flow. And it's not formally signed because nothing here says formally signed. It's basically a promise to pay. So instead of using notes payable, I'm going to use accounts payable. So accounts payable will be one of my items. And then what am I getting? I'm getting equipment. All right, so those are 2 of our accounts. The question is, what components are these? So accounts payable, I owe. Because I owe, that is a liability. And then my equipment is something that I have that I can use, that I can control, and that I can provide future financial benefits. So in this case, this would be an asset. And the dollar amount here looks like to be $9,600. So we'll put $9,600 there, $9,600 there. And then the increase or decrease. So did my liability go up or down because of this transaction? It went up. More liability. I owe more, so that's going to be an increase. And my equipment, that's going to increase because I have more of it, so that's going to increase. And again, we don't have 1 increase, 1 decrease. We can have 2 decreases, 2 increases, 1 increase, 1 decrease. We can have a mix of those 3 when we do this analysis. All right, so now we're going to look at this accounts payable here. It's a liability. It increases. And so then we've got a credit. So we'll credit accounts payable. Now, what about our equipment? Our equipment is an asset. That asset increases. An increase in the asset is a debit. Okay, so now let's go ahead and apply this to our journal entry. Debits go first. So we've got equipment in the amount of $9,600. And then we've got credit accounts payable for $9,600. So that would be our journal entry for this example on our computers and our promise to pay. So hopefully by this point, you're getting a little bit of hang of it. You're probably a little bit hung up on what accounts, and that's okay. It's all about practice. The more practice that you get at it, the better the accounts are. They just don't roll off your tongue. I get it. But the key thing that I always do when I'm looking at this is what was given and what was received and what was given up. If we can figure that out, I can try to make out what accounts there is. Cash is usually the best one, the easiest one, and then it's about finding the other one in the process. All right, let's go to example 5. Company pays $5,000 to the equipment supplier in example 4. So get this here. In this example 4, we bought this equipment, but we didn't pay for it. We have a liability. In example 5, we're going to pay it, okay, and extinguish this debt, okay? So that's what we're doing in example 5. We're getting rid of this debt because now we're going to pay it. Maybe we got the bill now, and now it's time to pay, all right? So, but in this case, how much are we paying? We're not paying $9,600. We're paying $5,000, okay? So we're paying $5,000 here. So I'm giving up $5,000, and what am I getting in return? I'm getting a release of my accounts payable. I no longer owe $5,000 in accounts payable. So I'm giving up cash and I'm getting a release on accounts payable. All right, so then what accounts are, what components are these accounts affected? So cash is an asset. Accounts payable is a liability. The dollar value here, it's not $9,600. Instead, it is $5,000. Cash, if I'm going to pay it, is that going to increase my cash balance or decrease it? It's going to decrease it. I got to pay it. I got to get rid of it. So decrease What about accounts payable? Well, am I having more liabilities or less? In this case, I'm having less because I'm extinguishing part of that debt. So in this case here, we're going to decrease our accounts payable. All right, so now that we have that, time to assign debits and credits to each one of these. So cash is an asset. That asset is decreasing. Decreasing means credit. Now, since there's only two things here, a shortcut to the next part here is I don't even have to look at the key because I know that journal entries must have a debit and a credit. Therefore, this right here must be a debit. So accounts payable, I must be debiting. Now I can check my work here. So accounts payable is a liability and that is decreasing. Decreasing is a debit. But again, if I can get one right, the other one has to be the opposite, especially if there's only two entries or two accounts that are being prepared for this journal entry. So debit accounts payable, credit cash in the amount of $5,000. So based on example 4, where I had $9,600 and here where I have $5,000, I still owe $4,600 to the vendor who provided me my equipment or my plant, property, and equipment. All right, moving on to example 6. In example 6, it says company A orders an app game code from a vendor. The vendor expects to deliver the goods next month. Payment has not been made. So the question is, at this moment in time, what was exchanged? Hopefully you said nothing. Nothing's being exchanged, right? The game code wasn't received. Cash wasn't exchanged. It really was just a promise to pay. And promises to pay have no journal entry. So there is no journal entry. So no journal entry. We are done with example 6. So it's important to understand that just because a transaction happens doesn't mean it actually impacts the accounting equation. And if it doesn't impact the accounting equation, we don't need to do anything with it. So we are good here with example 6. Moving on to example 7. It gets a little bit harder here on example 7. Company A receives $9,000 of the app game code ordered in example 6, pays $4,000 in cash and a promise to pay the remaining $5,000 next month. So a lot going on here. So what's happening? I am getting a game code. I am giving up $4,000 in cash, but that doesn't pay at all. So I'm also giving up a promise to pay of $5,000. In total, that's $9,000. So there's an even exchange of $9,000 given up with $9,000 given in product to me. So now that we have all of that, so what accounts are going to be impacted? Well, software, cash, and accounts payable. Right? So I'm getting a software, I'm giving up cash, and a promise to pay. The promise to pay is going to be accounts payable. All right, what components do these three things belong to? Well, software belongs to asset. It's something of a resource that the company has to provide future financial benefits. Cash is an asset, and accounts payable is a liability. All right, so we've got all those three there. Now the dollar value. So the dollar value of the software to me is $9,000. The cash that I'm going to give up is $4,000. And then the promise to pay is $5,000. So again, this is one of those situations where you have to break it up a bit so that we have an idea of what's happening from a monetary standpoint. All right, software, is it increasing or decreasing? Well, we're receiving software, so it must be increasing. Cash is out of my pocket, so that's definitely decreasing. And what about the accounts payable, liabilities? Do I have more of it or less of it? I have more of it. I owe $5,000, so I'm going to increase my liability. All right, so now that we have all of that, it's time to do the debits and credits. Now, don't get ahead of yourself. Just do one by one by one. Software, asset increases, debit. Cash is an asset, asset decreases, credit. Liability increases, credit. Okay, so step by step, one by one. All right, so we know that debits always go first. So the first thing that we're going to go to is our debit of software in the amount of $9,000. Then what's next? What's next would be either cash or accounts payable. It doesn't matter what goes next, as long as it's a credit. Now, if we had two debits, then we would put the next debit, but we have two credits. So any one of these can go first. I could put accounts payable or cash. It does not matter. So I'm just going to go in order here. Cash in the amount of $4,000 and accounts payable in the amount of $5,000. Now, A/P is a shorthand for accounts payable. I usually don't do shorthands when I'm just teaching it, but it just rolled off my pen here. So AP is accounts payable. So that would be my journal entry. Now notice here, I've got one debit, two credits, totally fine. Also notice my debits equal my credits. 9,000 on the debits, 9,000 on credits. I am good. This entry is a valid entry. So I think sometimes students get a little scared here when they're looking at this and they're going, oh, there's so much more to this, but there really isn't. Keep yourself organized and you'll get to this point. Now, there are times when I'll see like something like this, or I might see something like this, just because they feel like they have to have a 9,000 on one, 9,000 the other, but make sure it's just your debits must equal your credit. So in this case, $5,000. All right, let's move into our last example here in this first lesson. As we look at journal entry examples, company receives supplies costing $600 on account. Now, keyword here is on account. On account means I'm going to pay you, or I'm going to promise to pay you sometime in the near future. There is no notes that are signed, so it's not notes payable. On account translates to accounts payable or accounts receivable. How do you know the difference? You got to look at the context. Accounts payable means you owe. Accounts receivable means you receive. In this case, if I'm getting supplies, I must be owing that other person or that other entity. So it's going to be an accounts payable. So I'm getting supplies and I'm giving up accounts payable, or a promise to pay in the near future. All right, what components are each one of these? Well, supplies is an asset. Accounts payable is a liability. Now, some people would say supplies is an expense. It could be, but generally supplies, when I buy like a box of paper or a ream, well, yeah, a box of paper that has 10 reams in it, that's technically not used. I haven't used it yet. So that is just supplies. And then when I print on them, that becomes the expense. So if we were to go very basic here, supplies is an asset, then supplies expense is the expense. We move it to supplies expense when we use the supplies. All right, so we've got that there. Dollar value is $600. Supplies are increasing because I'm getting it. Accounts payable liabilities is increasing because I owe more. Now we need to do the debits and credits. So supplies is an asset. Asset increases, that would give me a debit. Therefore, leaving me with a credit for accounts payable. I can check that work. Liabilities, it increases, credit as well. So supplies is going to go first in the amount of $600, and then accounts payable is $600. Okay, so that would be our journal entry there. So that's the end of this first part. I know it took a long time. This is a long lesson, but again, you know, the key is just to really go back to the fundamentals and help you understand the steps necessary to get to the debits and credits and then prepare that journal entry. We only did 8 examples here, but we've got 6 more. Technically, we've got 7. We've got 6 more in the next lesson as we get to 14 examples in this transaction analysis. So until then, we'll see you in the next video.